Hello Proponomics people, and today's video looks at the recent released Bank of England Money and Credit Report. So this comes out once a month and has a few high level things in it. Normally the stuff that makes the headlines is just about mortgages in general, because looking at the number of mortgages that were issued obviously gives us a rough proxy for the idea of how healthy or not the housing market is at the moment. And of course, in the wake of the Liz Truss incident, and also in the wake of bond yields hitting even bigger highs in the middle of 2023, just because of the pressure there was on interest rates, thanks to that double-digit inflation that came in a wave in late 22, early 23, it's been a big deal because the mortgage market has been suppressed somewhat. So a little comparable to 2008, what we saw in sort of 2009 and onwards was the total withdrawal of credit, which started in 2008, and the only money there was around for a long time was very, very short-term money, overnight money, extremely short-term stuff. We also didn't have a robust bridging lending market at the time. We had a very, very, very niche and specialist bridging lending market, so much harder for people to get credit of any kind. So credit evaporating is obviously pretty much the worst thing you can do in a system where all the money around in the UK these days, 97% of it is credit. So that's how much we rely on credit. The second worst scenario is that price of credit moves up really, really significantly in a short space of time. And that's what happened. But luckily, because of a lot of the measures that were put in place after 2008 and the lessons that were learned and the regulations that were forced on the banks, apart from anything else that they've summarily continued to moan about over the last 15 years, actually saved our bacon quite a bit, and we didn't have a terrible time. And actually the whole Liz Truss incident was really a bit of a bubble deflator. That obviously wasn't the intention of what Truss and Kwarteng did, but it was a happy consequence that we had a bubble that was inflating in the UK property market. We were growing much too quickly, and it knocked the spots off that, and we had, instead of having some kind of horrible crash or even a correction, we had a correction in real terms as inflation ravaged the real price of property, but in nominal terms a couple of percent down on the year according to the ONS. So pretty good. Depends where you are in the country, what property, and all the rest of it. And also when you've gone from a market where things are selling at maybe 10% more than market price because it's so hot, to a market where things are struggling to sell at that market price, or 5%, 10% below, it feels like a lot more than 2% difference. It certainly does at this end whenever we look at disposing of any stock for any particular strategic reasons. So often the report only summarised as the mortgage numbers, and that will be in this video, but there's quite a lot more to talk about as well that I think is particularly relevant. So 1.5 billion of net mortgage debt borrowed in February 2024. That compared to 1.1 billion of net repayments in January. So a move upwards there. We had a 56,100 print for the number of mortgages approvals, that is, mortgage approvals for house purchases. 56,100 in January, 60,400 in February. 60k seen as a bit of a magic number, as 50k as we were below 50k a few months ago, and we even had months last year where we were below 40k. So obviously a 50% improvement on those months, but the more average, healthier market looks more like about 65 to 70,000. So we're not quite back to that yet, but of course interest rates are reasonably high, certainly when we look at things like a 10-year average for interest rates, for example. Some would say, of course, they've just normalised a little bit. I think they're still on the high side of normal, actually. If you look at what normal has looked like since the year 2000, let's say, as an arbitrary marker, we're still a little bit ahead of that at the moment, certainly in terms of base rate. So let's just see what happens. Net approvals for remortgages up from 30,900 to 37,700. So a pretty significant increase in remortgages as well, as people took advantage of lower rates than certainly in the middle and towards the end of 2023. So there we go. The effective interest rate, so that's the actual interest being paid on newly drawn mortgages, was down by a huge 29 basis points. So that fell to 4.90%, the rate that was being paid on newly drawn mortgages. Now, some of those, of course, will have been arranged in January, where the going was quite good and the rates were quite low. But still, some of those will have been arranged months and months ago, where the swap rates pretty much look like they did now. So absolutely brilliant news, under 5% there. We were well over 5.5%. We're actually over 6% on that number at some points during last year. So 4.9 is good, although all of the outstanding mortgage debt in the UK is fixed at a lower rate than 4.9. So that average rate is still going upwards, and that still has to have a little bit of a cooling effect on the market for obvious reasons. Net consumer credit borrowing went down to 1.4 billion from 1.8 in January. People tend to borrow a bit more after Christmas though, so I'm a little bit loath of reading too much into those month-on-month statistics at this time of year, really, to be honest. And UK non-financial businesses, so we're talking public corporations, repaid net 3.3 billion of loans to banks and building societies in February, whereas in January they only repaid 0.2 billion. So used their cash to pay down some debt because they obviously feel debt at the moment, some of it is too expensive. And then interestingly, the net flow of sterling money, they call it M4EX, which is a bit of a mouthful, and it basically relates to the money supply. It's very volatile at the moment still. We would rather we had stability there. It rose by 7.2 billion in February compared to a 0.2 billion move downwards in January. So that's a significant move, and that would be traditionally seen as relatively inflationary. And on the month-on-month figures for February, we did see 0.6% up in CPI, 0.6% up in core month-on-month. Having said that, again, comparing January prices to February prices is dangerous because January prices have often been cut to get rid of old stock from Christmas and all the rest of it. That doesn't form a huge part of the numbers these days, but when we're talking in the 0.1s and the 0.2s and the 0.6s, of course it does make a difference, so we do need to think about that. So households' holdings of money went up by 6 billion in February, which was, they increased by 6.6 billion in January. So household holding of money is expanding quite significantly. What does this mean? People are saving, right? Households are saving. Perhaps they're remortgaging to fixed rates and bringing some money out to save because they're still concerned about the wider economic environment, still scarred from the pandemic, still scarred from huge inflation, energy price inflation and all the rest of it. Perhaps they're doing it to improve their homes. But people are saving at double the rate they were in 2019. Perhaps they're just concerned about political uncertainty because there's an election coming up. There'll be all these good reasons for people to be saving at the moment. Saving is more driven by fears and by people's expectations than it is by rates. Although, of course, saving is, once again, finally paying a bit of a rate of return, and you can shop around and get north of 4% on your savings. Still pay income tax on all of that, of course, if it's outside of your allowances. So by the time the taxman's had their slice, it's still a paltry sum, to be honest with you. But you can do it, which you couldn't do for a long time. So, and then net flow sterling to private sector companies and households minus 15.8 billion. That's lending. Sorry, net flow of lending minus 15.8 billion, minus 3.2 billion in January. So a decrease in the flow of lending to financial corporations effectively is what the Bank of England have put that down to. So quite a significant decrease in lending. So less appetite for lending on that front from the corporations, which is interesting. The householders, on the other hand, are seeing it as these mortgage rates are better than last year, so let's get on with it. It seems like the message from the corporations is debt we still think is pretty expensive, so instead, do you know what we're going to do? We're going to pay down debt. Is that a good thing? Not really, because what we'd rather is that businesses were in position to take on debt, make investments, grow their businesses, whereas this sort of environment feels a bit more like, let's hold on to what we've got, let's hoard our labour, let's not look at investing too much. And again, that could easily be political uncertainty because of the election, because there are some noises being made that we're making some companies and some individuals feel particularly uncomfortable. So that brings the Bank of England Money and Credit Report summary to a close. Thanks for listening, and I'll be back tomorrow with a 4 Pillars video. Thank you.